If you bought silver over $130 or if you bought gold over 5,300, I'm sorry, I apologize, but things are about to get even more interesting to the downside. Look at this. If you look historically, history always repeats itself. Like it or not, believe it or not, it always happens. Silver crashes looking historically 1980s, 2011, 2026. Do you see some potential collusion, some potential relation? Look at this. There is a match between each of these crashes. There is a precision element involving part of the economy which always breaks or changes, which triggers always the same crash in precious metals. But I mean, let's look at the numbers. First of all, there is a sequence between the leverage positions, which are people who are buying with borrowed funds to go long on gold, to go long on silver. I don't have $100,000, for example. I believe the gold will go to $10,000 this year. Well, I'm gonna go long, but I don't have the money, so I'm gonna borrow the money from the broker, from the bank. I'm gonna borrow from third party, whatever. Same case with silver. So many people are blindly bullish for no reason. The problem is, like I mentioned, is that if you look back at the historical path of precious metals, economy, and the Federal Reserve policy, you will get an idea what the heck is actually coming on the market very, very soon. First of all, the people who are trading with leverage will get liquidated. They will be the one to actually trigger these forced liquidations. Second thing will happen is, of course, the Federal Reserve will come up with emergency meeting. You know what they actually did in 2022 during the banking crisis, right? They're going to come up with special meeting. What they're going to announce in the meeting? Well, we're going to improve the dollar because the dollar is the actual sustainability of the US economy. Strong dollar supports everything. Job growth, wage growth, and wage growth will catch up with inflation, which, as you may have guessed, will increase the buying power and will increase the buying power of the US dollar. Look at this. The shock that has been seen for many, many years usually starts with around 30 to 50%. Then there is a calm period where everyone thinks the market will recover, everything will be good, everything will be fine. People, actually, some of them are buying the dip. Some of them are saying, that's a buying opportunity. Go look at the precious metals bulls on X. Regardless, what happened next? There's another major plunge. And this plunge wipes out not only the dip buyers, it actually wipes out a lot of institutional investors who were staying put, but they already had such large positions with concentrated bets plus borrowed funds. So they're kind of the worst position possible, because you risk someone else's money, betting on someone else's thesis, and then in the end, when you lose, all the bankers are getting paid. Remember, the bonuses are coming regardless. They're getting also 1% from the money under management, regardless of the performance. So you understand who is actually the actual loser in any case possible. It's the individual investors, the people in the retirement funds, which fund actually invest in precious metals, right? Pension funds, these people. But let's go through the actual mechanics. So I want to make sure you guys understand step by step how this actually works, or how this actually have worked out in the past. 3 separate crises. First of all, silver hit $50 in 1980s. Okay, everyone was, woohoo, $50. Unfreaking believable. I'm gonna buy a car. But in April 2011, silver effectively dropped to $49.80. And this was already kind of a small, hidden sign that something is wrong, because silver was consolidated at this $50 range for a very long period of time. People were kind of treated silver like a stable coin, like it's not gonna move. It's not. And when the silver broke under 50, people, well, what went wrong? Something is off over here. Fast moving forward, the silver went to $121 in early January, right? Last month. And people had the same hype mentality, you know, the same hype that was when the silver hit $50 in 1980s. The problem over here is that right after this $50, the silver had 60 to 80% crash. Which, if you compare 1980s, go to $50, everyone is happy, everyone is bullish. 2026 January went to 121 or 126, depending of the chart, depending of the country where you're looking at. Then now we're waiting for this potential crash, which is, if we replicate the same identical, could be 100 to 150%. And this happens in months. Sure, as bearish as I am, I don't expect to drop 100 to 150% immediately or right now. But there is a two-way scenario where it drops one time substantially, which is 25 to 50%. This is plausible. Why is that? Because the silver already dropped in one single trading session 40%. So if the silver dropped 40% in one trading session this year, 2026, it's just show you what is possible. So if this is the case again, this means that we might see 20, 30, 40% or even 50% in one day. And then we might see a small drawbacks, 2, 3%, 1% down, 3% down, 1.5% down, little by little, but it will genuinely, you will feel the trajectory. Then there will be people who will be looking to buy the dip, right? Remember, there are people who have to average down, people who bought at 120, people who bought at 100, people who bought at 90. So if these people are not buying the dip, they're going to stay with average price of 120, which I don't know how many years these people have to wait to break even. If I was one of these people, I would be very pissed at least, or maybe angry. Because the other people who bought at 50 before the previous crash down to $18, they waited 15 years to break even. So let's run the numbers. This particular dip in 1980s was identical, 25-50% with the one that we saw in the end of January for 40% for silver. And this happened intraday session. This was not a couple of days. We're talking about intraday session throughout the day. Same thing happened over here with 40%. Well, open interest is the next thing that we're going to compare. Open interest back in the days, 1980s, was lower, right? Because the trading volume was lower. The amount of leverage was smaller and also harder to get to obtain. But now, it's much easier. People borrow left and right. So it's not so closely comparable. But you can still look that open interest hit all-time high for each of the precious metals. $200 million announced equivalents, which probably you understand that this is much out of the demand zone, right? With net longs, people who are going long on borrowed funds, 4 to 5x, and currently 35 to 50% of the futures, which I'm trying to give you like a simple explanation, or trying to give you a better understanding what this even means. This means that a quarter of the holders are not using their own funds to purchase or bet against or bet on this particular precious metals. They're using leverage. This means that this quarter of a percent, you can say 25% of the holders, if the market crashes again, this 25% will be the first one to be sold because they're going to be forced liquidated, which means 25% crash. It's pretty likely if we have the same setup. The question is, what's happened after 25% crash? Because then, the next people who are holding with their own cash, institutional investors who they hold with their own cash, they're going to decide risk management procedures. Don't forget that also a lot of people trading with algorithms and with computers on Wall Street. They're using alternative trading systems known as ATS. So they're programmed usually to obtain very strict risk management. So this means that the assets they hold, if they drop 0.3, 0.5, 0.7%, they have to trim the position. If the assets drop 3 to 5, they have to trim even more. So if there is like a 10, 15, 20%, who knows, they might actually liquidate the entire position. So this is why you want to study the history. History is giving you very good idea what you could expect in the future.